And the next principle? The next principle is capital. I'm not saying money. Money shows up in a whole bunch of places in what we're describing as we seek to become an entrepreneur who makes a difference, who makes something that grows. But capital has a specific meaning. There are lots of ways for entrepreneurs to find and use capital. It fills our days thinking about how we're going to get it. And it changes almost everything we do once we do get it. Too often, though, entrepreneurs make a mistake. The mistake they make is they'd like to get back to work, so they try to get the raising of capital over with. It becomes really urgent when your work is up and running, when you have a payroll to make, and your back is against the wall. Because now, suddenly, there's a lot at stake, and there aren't many choices. This is a symptom that, from the beginning, your plan about capital maybe wasn't everything it could have been. So let's break it into pieces. We begin with this. Money is a story. Everyone tells themselves a story about money, including you and me. So do investors. So do banks. So do people who are offering capital. Because when we think about it, money is nothing but a story on the screen. It's not something that lives in a wheelbarrow or that you can actually touch. Even dollar bills are nothing but a stand-in for what you can trade them for. And what we trade them for and what it costs us to get it are at the heart of what we're dealing with when we're dealing with capital. I'll start with this rule of thumb. Don't borrow money to buy something that doesn't go up in value. That the essence of capitalism, all the way back to Adam Smith, is get some money and buy a machine. That machine will pay for itself. We can expand that to get some money and get an education. That education will pay for itself. Or how about this? Get some money, hire some people, make some stuff, build a brand. That brand earns trust. That trust leads to engagement, people paying a premium. That's a business with goodwill that makes a profit. It will pay for itself. But getting money to pay expenses is a trap. Because expenses, things like rent or insurance or whatever, aren't going to pay for themselves. They're simply going to enable you to do something else that might pay for itself. So we have to begin by being clear about what the money is for. Because one of the forms of capital you have to invest, it's confusing to use this word, is time. Time is money, of course, because there's an opportunity cost because you could spend your time, going to a job. But if you are investing your time, you've already begun going down the path of saying, I'm making an investment in what we are building. From the very start, these investments change what kind of organization you're going to build. So let me give you some famous examples at either end of the spectrum. At one end of the spectrum, you've got a really good idea. You know how to code, or you know people who do. You go to Silicon Valley. Before you've done much of anything, someone shows up and puts in $4 million. They don't give you $4 million. That's really important. They make an investment of $4 million in exchange for 20% of your company. What that means, of course, is that they valued your company at $20 million because 20%, $4 million, do the math. And so out of nowhere, you are running a company that apparently is worth $20 million. But this person who put in the $4 million, they want it back. How are they going to get it back? Well, in the old days, they'd want you to make a profit. But in Silicon Valley, what they want you to do is be big. Be big so you could be bought by Cisco or somebody else. Be big so you could go public and be worth $1 billion. Because if a $20 million company ends up being worth $1 billion, a unicorn, you've increased the value of the company by a factor of 50. That is what the $4 million investment was for. The $4 million was not to pay your expenses. The $4 million was to lean way outside the boat, all in, to figure out how to do something that the public markets will want to be part of. How to grow at 10% a week, not 10% a year. Well, once you've taken that check for $4 million, you've just signed up for a certain sort of marketing, a certain sort of customer base, a certain sort of employee. You've signed up for certain kinds of lawyers, certain kinds of accountants. You don't get to go back to normal. This is the new normal. That $4 million came with a really big price tag, which is spend this money to gain customer traction and to grow at hyperspeed. That's what the money was for. Oh, so that means that if you want to run a different kind of business, you're going to need a different kind of money. All the way at the other extreme is the idea of bootstrapping. Bootstrapping is fundamentally defined as how you build a business where your customers are your investors. How could your customers possibly be your investors? Well, the simplest example is they pay in advance. If you want to book a concert and that concert's going to have 600 seats and tickets cost $20 each, if you sell out, you're going to bring in $12,000. If $12,000 covers the cost of renting the theater and paying the act, suddenly you're in business. So all you got to do now is find 600 people who want to buy a ticket in advance. If they buy a ticket in advance, they've just funded the whole operation. Kickstarter put a software name on this, but it predates Kickstarter by a lot. The idea is to organize customers who need something so badly that they will eagerly pay you upfront to get it. Now, there are variations in between. For example, if you get customer commitments, it's a lot easier to go to a funding source who will bridge you from where you were to where you want to go. Two big ideas so far. One, the choices you make about the capital you raise and how you raise it will change everything forever. And two, time is money. That when you put your time into something, that is similar to investing money. Now the third big idea. Time is also the critical factor when we think about investment, when we think about capital. In the bootstrapping example we just heard, time matters because if your customers pay you 2 months after you build something, you're on the hook to finance it. If they pay you 2 months before you build something, they're funding it. The same thing's true with what's going on in Silicon Valley. Someone shows up really early to the game, takes a big risk early in the process, and as a result, ends up making a fortune, if they're right, way later in the process. So the first thing you have to do is understand that cash flows. It flows out when you're spending it, when you're buying a machine, when you're renting an office, when you're meeting payroll, when you're running an ad. And it flows back in when customers buy something from you. It's a mistake to ask people on the finance side to paper over challenges you're having with cash flow. Cash flow is something you have to design for. So if you look at the history of Google, for the first 2 or 3 years, they had no cash flow. There were a few exceptions, special projects, but in general, because there were no ads on Google, no money was coming in. All the servers, all the payroll, all the beanbag chairs, all of it, you just have to pay it up front. But the bet, which was mostly made by people who had more money than God, was one day soon, we'll figure out how to make money. If we just get big, we'll be fine. And the alternative all the way at the other end of the spectrum is somebody who figures out how to trade time and time alone for the chance to get cash flow early. When I started my career as an independent entrepreneur, I had almost no capital to invest. How then to do the work that I wanted to do? Well, I had to pick my customers because, as we're going to hear over and over again, when you pick your customers, you pick your future. It turned out in the 1980s that the book industry in New York City had a problem. They were capable of publishing about 50,000 books a year, and they didn't have enough good books to publish. In particular, there was a shortage of complicated books, books to be built by a team of people as opposed to an author writing a novel. And the business model of the book industry, because it's fueled by authors, is simple. You send in a 5-page proposal. If they like it, they give you money in advance to tide you over while you write it. And then if it works, they pay you a royalty. And so I sold my first book the first day for $2,500. I got half. I split it with my co-author, Chip Conley. And I realized that with customers like this, I might be able to build something. I then got 800 rejection letters in a row. 800 times I went to book publishers and I said, I have an idea. And if you put up money, I'll make it. And 800 times in a row, they said, no, thank you. Now, the sum cost of this was $500 in stamps. I also had to pay my room and board. I had to survive. But I was trading my time for a chance to earn customers. And over time, month after month, we built a customer base. I ended up creating 120 books in 10 years. I built my team to almost 10 people. We did a lot of really cool stuff. We sold millions of books. And I never went to a bank. I never had to raise money from an outside investor because my investors were people who were in the business of supporting and investing in exactly what I was doing, which is they said, oh, we see the thing you're trying to create. We have capital. We're going to own most of it when it's done because we're only going to pay you a royalty if it sells. Go make it. Go make the business almanac. Go make test prep books. Go make this directory or that digest. And so I did. There are places where you can do that. There are other places where you can't. At the same time I was doing that, my dear friend Lynn had great ideas for what to do with toys, soft goods, things for little kids and their parents. She went to one toy company after another with her ideas, and people slammed the door in her face every time. You know why? Because toy companies are bad customers. Toy companies didn't want to buy what she was selling and didn't want to buy it the way she was selling it. They care a lot about trade secrets. They don't care a lot about paying royalties. Most of the time, they own and operate their own stuff. Pick your customers, pick your future. Now, I'd like to dissect why entrepreneurs are so stressed about capital. Either they're stressed because they're in trouble, they're in debt, they're behind, or they're stressed because they don't know how to get more and they want to grow. These are both symptoms of being afraid of your spreadsheet, symptoms of making bad choices about the timing of when cash comes in and when cash goes out, and difficult choices about where the money comes from in the first place. So the most important thing you need to do is make a cash flow statement. Do it in Google Sheets. It's free. Chart out every single month for the next 3 years. For every month, what do you need to spend? Where is the money going out? You could be spending it on payroll. You could be spending it on rent. You could be spending it buying new machines. I'm not talking about any of the fancy accounting stuff like depreciation. Ignore that. What we care about is what money do you need to spend in May? What money do you need to spend in September? Month by month by month. Actual cash you have to put out the door. Okay, now for each month, list where is money coming from. Now it could be that 5 months ago, someone bought something for you and now the check has finally arrived. You have to list it when the check arrives, not when it was promised to you. Month by month by month, where is the money going to come from? As you chart this out, here's the question. Where in this spreadsheet did you assert that a miracle is going to happen? That a miracle is going to happen because you're going to be on the front page of the local newspaper or website, and so many customers are going to come just in time, you'll have to turn them away. Or that a miracle is going to happen because your cost of goods is going to go down, but the price you can charge for them is going to go up. Or a miracle is going to happen because your staff is going to suddenly work for less money. You get the idea. All of those places where you are not able to fill in the blank and are wishing, that is why you are stressed. That is why someone's not showing up to fund what you're doing. Because they look at the spreadsheet of cash flow and they see cash flowing out and they see miracles requiring cash to flow back in. And what it means to be an entrepreneur, unless you're one of those people who needs to be in the magazines and raise all that fancy money, is that you are comfortable with your cash flow, that you are choosing to grow something at a scale you want to grow it, to make the difference you seek to make, and you are comfortable with your cash flow. And so now, you're going to need capital. You might just need capital to pay for rice and beans and sleep on the floor of a friend's house, but you're going to need capital. So now that you've got this spreadsheet of cash flows, you need to look at where does capital need to show up? When is money going to be required? Maybe what you need is $1 million to buy a laser cutter. And once you've got the laser cutter, after that, all the cash flows in the right direction. Maybe it's not like that. Maybe you have a 2-year runway where every month you're losing just a little bit less money until after 2 years, it goes in the other direction. Stepwise, gradual, here we go. It's going to work, but you're going to need some capital. Different kinds of capital requirements lead to different kinds of funding. So I'll start with the most dangerous two. The most dangerous two happen when you shift money and time by borrowing from your future self, by mortgaging your house or using credit cards. Because what you can do, for example, in this 2-year stepwise progression, is say, well, for 2 years I'm going to be losing money, and then after that I'm going to be making money. So I will borrow money from the me in the future by putting it on my credit cards, by mortgaging my house, by personally guaranteeing the money. And that can work. It's really scary, but it can work. What it means, though, is you need to be super comfortable about the assertions and assumptions in your cash flow statement. Because if you're wrong and you've borrowed the money from yourself, then you're out of the game. And part of what it means to be an entrepreneur is to stay in the game, the resilience to stay in the game. The story about money means that your story about money might be different than an investor's story about money. They might view losing the game differently than you. An investor can say, I'm going to invest in 10 sort of high-risk small businesses. And if only 4 pay off, I'm fine. 4 out of 10, that's still Hall of Fame batting average, but you don't want to play those odds. If it's your money and your house, you need 100%. Why not go to someone who's happy to settle for 40% and offer them the same deal if they will take the risk? Okay, so if you're going for outside funding, the first rule is you're not personally guaranteeing it. Because if you're personally guaranteeing it, it's not outside funding. It's your funding. What you've done is said, I'm willing to sacrifice my family and my future to make this work. Well, then you're already in a place that I don't think you should be. Now, there are different kinds of funding. We mentioned earlier Silicon Valley. That's equity funding. There are a lot of laws in every country about how equity is treated. They are actually owners. We could talk all day about what it means to have owners and people you have to deal with forever, but we might not be able to get into that. Instead, we want to talk about the difference between debt and equity. Debt means that once you pay it back, you're even Steven. That you are borrowing money, but you still own the company. And the question is, borrowing money against what? Well, one thing you can borrow money against is just your company, that I will pay you back or you get the company. But more interesting is to borrow money against a specific project so that you can go to people, this works in the fashion industry all the time, and say, I just got an order from this department store for $100,000 worth of blouses. I got to go pay the factory $50,000 to make the blouses. I know the department store is going to pay me in 3 months. I need $50,000 to pay the factory now. That's called factoring, and it's available in some industries. That what you're doing is papering over cash flow without taking any risk, because what's happened is the department store won't pay you up front, but the factory wants to get paid today. So you can go to people, whether they're organizations, companies, or just well-off individuals, and say, this is what I have on offer. You put up this money, you get, by law, legally, in writing, this cash flow that comes when it comes around. And if people aren't willing to take that bet, I think you need to think hard about whether you should take that bet, about how risky it is that that cash is actually going to show up. Wow, there was a lot here. Maybe not what you expected, not a lot of shortcuts or hacks or tips about how to raise that money you urgently need. Because getting your strategy right about money, becoming comfortable with your cash flow model, enables you to go to work, to do the work you seek to do, to help the people you're trying to help, to build the business you want. But if you build a structure that is dependent on outside financing to cover your cash flow, you're going to be dealing with that for a long time. So yes, it's entirely possible to build something bigger and faster. And entrepreneurs want to build something bigger than themselves. The heads up here is make sure it's in alignment. Make sure the thing you seek to build is matched by what your customers want and what the financing sources are willing to support.